All right, I am Carlo Duran. I am the Financial Literacy Specialist for the Army Reserve 88th Readiness Division. There's my contact info. There is a QR code if you want to jump on my calendar. Today, we're going to be talking about TSP investments. Okay, so here's TSP. Click on investments. You can click on your investments, which is a portfolio, or you could click on fund performance, which shows you all of the investments available in TSP. You could click here, and this shows you the fund performance table for year to date. You could go last quarter, you could go last 12 months, you could go last calendar year, or you can do your own range. I don't believe it'll go past a year. This is year to date, which is January 1st through yesterday, close of business. Since these funds don't trade actively on an exchange, then it won't update until, or the performance won't update till a couple hours after close of business. All right, so let's take a look. These are the life cycle funds from least aggressive to most aggressive in order. But before I explain those, let's go to the normal funds. You have G funds, which is government securities. You have the F fund, which is fixed income bonds. You have the C fund, which I think the C fund stands for corporations, maybe, but this is basically the S&P 500. The S fund is small caps, which typically is the Russell 2000. This I fund is international funds. Okay, so I'll get into performance in a second. So these life cycle funds, all they are is a mix of these funds down here. That's all they are. Okay, it's an allocation. So for instance, this is in the income phase. Now what that means is people who are in this should be actively pulling from this fund. Now, what you don't want to do, why they have income fund, is you don't want to be fluctuating in the market and withdrawing at the same time. Because when the market's down, pulling $1,000 may cost you $1,200. Now, when the market's up, you may luck out, but we've shown in research and Monte Carlo simulations that the first year that you're withdrawing dramatically impacts the longevity of your funds, and which means how long you can withdraw from them. So, for instance, if you withdraw in a year that your portfolio is down 10%, that is going to drastically cut how long your funds are going to last. Now, you can start withdrawing funds and the market be up 10%, and that will make your funds last longer, but you don't want to be in that situation of your market the market's fluctuating and you're in a prolonged bear market and you just can't stand it anymore and you have to withdraw. You want predictability is better than just getting lucky. Okay, so that's what the income fund is for. It's to keep it relatively steady so you can withdraw from them. Now, this is primarily going to be G fund and F fund, which is fixed income and government securities, which aren't going to fluctuate very much. Now, bonds have changed. The idea of a portfolio with the majority of bonds in it has changed a little bit, and I could talk about modern portfolio theory in another video. But this is going to be bonds and securities, okay, or bonds and G fund. It's returned. The way you read this is for April, it returned 0.67. That's last month. Okay, quarter one, that's January through April, it returned 0.46. Okay, the rolling year. So if you look back the entire year from today, it has returned 6.61%. The 3-year average, it's averaged 6% over the last 3 years, and 5 years, over the last 5 years, it's averaged 5.4% per year. Now those numbers look phenomenal for this type of fund. Okay, and the reason it looks phenomenal is because of the G fund. The G fund is United States Treasury, and treasuries are high right now, which is typically bad for investors in stocks. But again, that's a conversation for another day. So the next fund is 2025. This is a little more aggressive, and you can tell because the rate of return is different. Okay, now every time one of these what call sunset. So the life cycle fund for 2025 means you're going to withdraw sometime this year. Okay, and after this year is over, this fund is no longer going to be available. It's probably going to go to L income fund. Okay, because we've reached 2025. So these are years. So this is typically the year that you want to withdraw. So this fund you're going to want to withdraw in 2030. So 5 years from now, it's going to start getting more conservative, but you can see here it's still returning a decent amount because it's a little more aggressive than these. Okay, now these are not static. These are going to move on you, right? As because they're rolling, it's a rolling year. So if the market were to crash next month by 10%, then you would see that this 1 year is going to be drastically different. So don't let these numbers fool you, because if you look back in 2008 or early 2020, these were very nasty, and this was probably more stable. So because the market has been on an uptick for the last few years, then these numbers are going to be really good. But don't get confused and jump into these saying, "Hey, I'm going to get a 10% return every year." That's not how it works. These could drastically change overnight. Okay, L 2035. That means you're going to start withdrawing in 2035. It's a little more aggressive, and all the way down to 2065 and 2070. Now you can tell 2065, 2060, 2055 all got very similar returns, and that's probably because they cap it on how aggressive it's going to be. Okay, it's they're not going to go 100% international or 100% um, Russell 2000. Those are probably the most aggressive you can get. It's not doing that. It's going to have a little bit of each fund in it. It's going to have maybe 5% of G fund. It's going to have maybe 5% of fixed income, and then larger chunks of the stock allocations, just so it can capture the market upside. Okay, now you can see we had a rough time a little bit in quarter one on these. So they are negative in quarter one, but we did get a rebound in April. So those are the life cycle funds. Typically, you only want to choose one life cycle fund, and that's because it's going to mess with your allocation, right? So if you have an allocation that is, it's hard to do this without drawing. If you have an allocation that's like 20% G fund, and you're in that life cycle, and then you have another life cycle where you're 50% G fund, then those average together, and you're actually going to be 40% G fund, which doesn't make any sense, especially since you can't see the withholdings in each one. So if you're going to have 2 life cycle funds or 3 life cycle funds, you might as well do the allocation yourself, because the life cycle funds move. So as we get closer to this 2035, it's going to get more conservative as you get to L 2035. And then when you get to L 30, 2035, the year 2035, it's going to be mostly bonds and cash, mostly bonds and G funds, so you could withdraw it. Okay, so these move. That's why you don't want to be in 2 of them, because they'll be moving at different increments, and you won't have any idea what your actual allocation is. So if you want a specific allocation, you're going to have to do individual funds. Again, and these life cycle funds are just allocations of these other funds. Okay, we call it a fund of funds, but yeah, that's what they are. So if you look here and you drop the PDF, it explains everything I just explained to you if you want to read it. So let me move it over. Computer's moving kind of slow. So these it explains everything about the life cycle funds, the different life cycle funds, um, your target dates, expense ratios. Now these are very good expense ratios. Um, yeah, very good expense ratios. You won't find those anywhere in the private sector outside of ETFs. Oh, here's some allocations here. Yeah, so you can see the 2070. Yeah, see these four are all 35% I fund, 51% C fund, 13% S fund, and then very nominal G fund and F fund. Now, as you get over here, they start allocating more and more to the G fund and the F fund. That's weird. So remember I talked about the fixed income has changed, or bonds have changed how we look at them because bonds have crashed and stayed low for a long time. That's interesting that TSP has allocated just 7% across the board, almost across the board to F fund. That's interesting. They mostly rely on G fund. That's because G fund is you're going to get a higher return and you're going to be safer than F fund. Typically, the F fund replaces the G fund because when interest rates are low, then the G fund is going to not return very much. It's going to return, 0.5%, 1%. But since interest rates are high, it's returning a lot more. Um, if Trump starts well, Trump doesn't cut interest rate. If Trump's Fed starts cutting interest rates, you may see a little more allocation towards the F fund here because G fund is gonna tank a little bit. All right, um, this is interesting. Yeah, so this one PDF covers all the L funds, all the life cycle funds. All right, so there's that. Let's talk a little bit more. Let's go to change investments. So let's say you think you're allocated incorrectly or you want to change something up. Click change investments. Now you could change your investment mix, and this will be you could do current or you could do future allocations. Um, or you could move between funds. These are kind of confusing right here because you could do move between funds over here, or you could do move between funds over here, and that's what you're currently invested in. So if you have everything in the G fund and you want to move some of your current balance to a different allocation, you would do move between funds. If you want to change your future allocation, so let's say you're good with your current balance, but you want future contributions to go somewhere, then you would do a change investment mix. All right, so let me get started. So yeah, it asks you here money that's already in the plan or money that you're going to contribute in the future. Okay, so let's say money that's currently in the plan. Come on. All right, so your existing mix, it's going to show you right here in the existing mix. I am 100% L65. Okay, now if I wanted to go to G Fund, I would just do 100% here. Um, or it's everything's got to equal 100%. So if I wanted to do 50 here, if I want to do 50 here, then that equals 100%. That will change your current mix. Okay. Now let's go back. I wanted to cover one more thing on these investments before I hopped off. Let's go back. Can I just click back or is that going to mess me up? Ah! Dang! No! I don't want to do that. I gotta log in again. 073. Alright. Pain. Alright. Let's go. Alright, let's go to investments. And let's go to fund performance again. Alright. One more thing here. If I go to change investments, there's one more option here. Okay. This is what's called a mutual fund window account. So they give you access to widely available mutual funds in the retail sector. So the G Fund and all those funds we talked about are specifically for TSP that TSP manages for you. Now, this mutual fund window account will give you access to fund managers outside of TSP. So let's get started here. All right, so it tells you everything you need to know about it. So, I mean, this looks pretty generic, but let's look at the fees. So, you have a fee schedule here, which is normal, and then you have administrative fees as well, which is normal. Last time I checked this, it was pretty outrageous, but let's take a look. Oh, it's blocked. Why is it blocked? So the last time I checked this mutual fund window account, it was very expensive. Um, it was didn't make it worth it, but you can invest in like American funds, TSP, American funds, T. Rowe Price, um, stuff like that. There's a lot of restrictions on it. So here are some of the restrictions. Um, I've always told my people that really this doesn't make much sense because the fees are so low in TSP, and and there's too many restrictions on it. And even if you did have access to mutual funds outside of TSP, what would you invest in? Like if somebody could give me a solid, they want to say, you know what, I'm in an American funds, XYZ American Fund of America or whatever, then and it's doing really well for me, and I love that fund, and I want to track it with this. I've said, okay, fine, go ahead. That may be a good idea. But other than that, I don't think window, this mutual fund window account is very good. But I wish I could see the fees just to show you. Oh, there they are. Okay. Here it came up. Let's take a look at the fee schedule. All right, and you got an annual maintenance fee. You have mutual fund purchase sales. That's a transaction fee. Exchanges. There's a fee for exchanges. Exchange between fund families. So there's some transaction fees, and you have to have 10,000 minimum in order to invest in that. But also, these are just TSP fees. You're gonna have the fees within the actual mutual fund that you are investing in. So if it's T. Rowe Price fund, you're gonna have their fees. If it's an American fund, you're gonna have their fees. So it's TSP fees and it's the mutual fund fees. And the mutual fund fees are typically double or triple what TSP's fees are. So not only are you going to pay double, triple in the fund fee, you're going to pay transaction fees with TSP as well. So I would look at that. I would be very careful looking at that option. Let's see if you can take a loan. Although amounts of interest are included in the amount of the loan, you can't borrow or withdraw directly from your MFW. In order to request a loan amount, you need to transfer MFW funds back into the TSP. So you can't take loans against this MFW account. You have to sell out of those and transfer back into TSP in order to get those uh, get those funds lent to you. So be careful with that. But that's just an overview